Good afternoon and welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at MarketSite is Ed Egilinsky. He is the head of alternative investments over at Direxion, and we're here for an update on the commodity markets. As always, thanks for joining us at MarketSite. And it seems to be a pretty good time right now to have this conversation. Emerging markets, that's a really hot topic in financial media right now. How is that impacting commodity prices?
Well, there's definitely a tie between emerging markets and commodities. As you know, a lot of those emerging market countries are heavy consumers and producers of commodities. So when you look at the emerging market equities this year, they're all down in varying degrees. That's had a major impact on most commodities. But when you look at supply and demand, that's going to dictate commodities first and foremost. And that's why oil has been able to separate itself this year relative to most other commodities.
Right, and how would you say trade wars could potentially impact commodities?
Well, we're seeing it today. Trump talking about imposing another $200 billion on the Chinese. And then you get this risk-off sentiment today, for example, where treasuries get a play, the dollar strengthens, and commodities tend to go down as a result.
Right, so the relationship with commodities and the U.S. dollar, if the dollar is stronger, that impacts commodities to the downside for the most part?
You know what, it's interesting. We looked at this over the last 28 years. It's almost been pretty even between calendar years where the dollar's up and commodities are up, and when the dollar's down and commodities are still up. So despite the misnomer or the fact that a lot of people feel that when the dollar strengthens, that hurts commodities, and inherently does, it's not necessarily the case when you look at it on a calendar year basis. What gets hurt the most probably when the dollar strengthens, especially during this period, has been the metals.
Right, right. And so we've been seeing that in gold for sure.
It definitely. You've been seeing it in gold, silver, and the industrial metals for the most part, most notably copper.
Right. Let's get back to the crude oil conversation. Sure. What factors are going to push it higher, and why are you looking at the spread between Brent and WTI? Why is that so key for oil traders?
Well, I think right now, I think oil still has an upside bias. You've had some mixed data come out this week in terms of increase in oil rigs, but a little more supply in the market now. But when you look at the macro events, especially what happened in Iraq this week with the potential violence there, they're the second largest producers in the OPEC. So when you look at some of the data that you see for August, that doesn't take into account what's happened in September with some macro potential geopolitical events, particularly in Iraq, the ongoing situation in Iran. That is going to create some spread between West Texas, which is mostly North America produced, versus the rest of the world, particularly Europe, Asia, the Middle East. And as a result of that, that spread has widened to the largest it's been in quite some time. And I think that spread could continue to stay at about the $10 range that it's currently at. Historically, it's about a 3 to 5 range between West Texas and Brent crude.
So if you have the geopolitical risk in there with Iraq potentially going offline, right, if there's service disruption, that would put a bid into it.
Yes,
correct.
And I think that's why you've seen crude hold steady here, because of those potential geopolitical risks and the contagion potential in the emerging markets. Turkey, despite not being a major producer, for example, of oil, still is a major transporter hub for oil itself, especially to China and parts of Europe. So the ongoing situations and really the ever-changing landscape, political landscape, whether it's tariffs or the potential Iran sanctions, could really put a floor to crude where it is now, or maybe plus or minus $1 or $2 downside from here.
Now, what about gold? What's it going to take to get the gold bugs back?
It's a good question. Gold has definitely been a laggard. I think there are a couple of reasons for that, most notably the strengthening dollar. In conjunction with the fact that rates are starting to rise here. As you know, gold doesn't have a yield associated with it. So when you look at gold, I think it's going to take a weakening dollar first and foremost. What's also facilitating maybe the downside in gold is with the emerging market potential contagion, people are looking to liquidate things that are easy to access, to raise cash, and gold is one of those things. So I think as a result of what's happening in the emerging markets, potentially, sovereign wealth, et cetera, I think that's contributing also to the downside maybe that we're seeing, or the pressure in gold. Two bright spots maybe for gold, though, that are contrarian indicators. Short interest is at record highs for gold right now, and volatility in gold is roughly at a decade low. So if you're looking for a silver lining, those two might be it outside of a potential weakening dollar.
All right, let's wrap it up with some strategy here, and we'll focus on gold specifically because it does sound like an interesting situation. What Direxion ETF are you using to position for that?
Well, we don't have anything in the physical gold space, but if you wanted to use tradable type of ideas in gold equity stocks, Nugget and UGT and Dust, that's a triple leverage bull and bear gold miners, along with junior gold miners, which is JNUG,
Right.
and JNUG for that as well. Sorry.
All right. Well, thank you very much for joining us. Always great to catch up with you at MarketSite.
Good seeing you.
And thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.